Welcome everyone to this session. This is tax tips for auditors. My name is Monty Glanzer. I've been at Hanson Weevil for about 12 years, a little over 12 years. I'm a manager on accounting and auditing department. My co-presenter is Matt Hale. So Matt, do you want to say a few words about yourself?
Sure, same thing Monty said. I've been at Hanson Weevil for more than a couple years. I'm in the A&A department. I do quite a few tax returns, individuals, and flow-through returns. I will say we do accept tips for this, and being around the holiday season, cookies and things of that nature, I think are always appreciated. And I also feel like we need to give some kind of Surgeon General's warning somewhere along those lines, but I think I saw Rich was on here. So the thoughts and views by Monty and myself aren't necessarily those agreed by Hanson Weevil or the tax department. So, but I'm sure Rich can jump in and correct us where we're wrong and when we're wrong on some of these things, but hopefully it's not too much in there. So.
Yes, yeah, good thing we'll have some good quality control on this session. Just a few things you've heard a number of times throughout today. We'll be throwing out code words, so you can go ahead and pull up the valuation and to put those in there as we put them on screen. And please don't share them in the chat if you miss one. And of course, this session is being recorded, so for future use. So if you do participate, put yourself on screen or speak up. You're giving your consent to do so, as you'll be recorded, and also just please don't provide any private information. But in general, this session is going to be, as auditors, we gain a lot of knowledge about the operations and accounting of our clients, and that knowledge can translate well into preparing and reviewing tax return, and just being overall providing communication with our tax department as well as our clients.
And I'll just add, a lot of times we're the first point of contact for a lot of our tax clients, not all of them, but a lot of times we see things first. So we really need to rope the appropriate people in to plan appropriately with that. So
yeah, for sure. So our agenda, just kind of throw all those up on screen. We're gonna be talking about a lot of these topics, some more than others, but and a lot of these topics are the same. We did the same kind of session last year, so a lot of the topics are reoccurring. So we left a lot of those slides intact just for reference, but we'll go into some of them more deeply than others. Starting with the book tax differences. So common book tax differences. So most business owners want to understand what their accounting's up to, but they also want to understand what those transactions mean, how it impact their taxes. And transactions can be treated the same for both book and tax, but there are various transactions that, due to nature or the timing, that are going to be treated differently, and that's when you have a book tax difference, and that's applicable to lots of different entities. I mean, partnerships, C corps, S corps. And depending on certain thresholds where you communicate those book tax differences is going to vary, but it's typically either going to be a Schedule M1 or Schedule M3, and there's some thresholds there. I think if entities have at least 50 million in total assets, they're required to complete the entire M3, but anything lower than that, it could be a combination of. And then, of course, the financial reporting, the basis of financial reporting is going to also make a difference in what kinds of book tax differences and how many, frankly, because if you're using GAAP for book purposes, you're going to have more book tax differences than if you're using the tax basis of accounting for your financial reporting, which is generally used for income tax reporting. So, and then the nature of the book tax differences are going to be and permanent in nature, and so we'll kind of go through some common temporary book tax differences and also some common permanent differences. So the next slide, we kind of go through some common temporary differences. So temporary meaning that it's going to reverse at some point in the future. It could be the next year, or in this, probably the most common example of a book tax difference is going to be depreciation. And so depreciation, if you buy a $100,000 piece of equipment and for book purposes, you depreciate it over 5 years, but then on the tax return, you can deduct it 100% of it in the first year through bonus depreciation. There's going to be difference in that deduction through those 5 years until you. So after those 5 years, both book and tax have had the same amount of deduction. So in general, with depreciation, GAAP is straight line, and then there's going to be accelerated methods for the IRS, and this is going to, and particularly if there's bonus depreciation involved, it does create a larger book tax difference because you can take a lot of that deduction up front for the tax. But also, it's important to remember, not only do you have the book tax differences to kind of sort through, but then you might also have federal and state differences because there's some states that do not comply with the bonus depreciation rules. And so you might have, you're going to have differences there, and various states treat how you reconcile those differences going forward. So just note there to remember the federal state piece as well. And also, I don't think this is on the slide, but amortization can also be a book tax difference for intangibles, most likely because the IRS has a prescribed amortization period that might be different than what we use for a GAAP. And because of those depreciation and amortization differences, then when you go to sell depreciable asset, if it's not fully depreciated, it's most likely going to have a different adjusted basis for book and for tax. And so there's going to be a gain or a loss difference reported in the books versus tax, which will create another temporary difference.
And one thing I think as auditors we need to look out for is it's more of a presentation wise. If when you dispose of the asset, if it's just an abandonment, typically you're not going to put that on the gain loss schedule on the tax return. You need to break those out separately as abandonment loss in the schedule. And I don't always see that. Sometimes it's a correction or a comment that I think I have to come out there. It's not a big deal. It's just a presentation type issue with it.
Yeah, that's a good point. Certain just accounting policies might create book tax differences. A good example is the allowance method for bad debts that we can use for GAAP, but tax typically has a direct write-off method, so there's going to be differences there. In compensations, well, accrued compensation or bonuses, you can accrue it for books, but it's only deductible on the tax return if that accrued compensation or bonuses are paid within 2.5 months after year end. And so if that's the case, then there won't be a book tax difference for that year unless there's another temporary difference from the prior year that's reversing. But in general, for that year, there wouldn't be a difference. But if you accrue $100,000, but you really only pay out $80,000, or you pay $120,000, any difference from that $100,000 that was accrued is going to be, or if you pay it 3 months after year end instead of 2.5, there's going to be a book tax difference. Go ahead.
Yeah, and I would just say another helpful hint is typically we're doing an M1 schedule or something along those lines. For those type issues that are paid within 2.5 months year end, I will document who I inquired and when.
Yeah.
You know, as of CFO or as of controller told me they weren't going to pay any, right? So I have that note because I know the tax department is going to ask about that as well. So, and it gives you a frame of reference. When did you ask them? Because things could have changed. So that's just a helpful hint that I do. So.
and then specifically for accrued compensation for shareholders, I think that has to be paid out by year end to be deductible. And then in the last point there on 263A, I'm not going to get too much into this, but it's the uniform capitalization rules, where we're taking certain indirect costs and capitalizing them to inventory. That is going to create a book tax difference because we're obviously not doing that for book. But I think we'll probably mention it later on that there's a small taxpayer exemption or threshold. Like if gross receipts are $25 million per year for 3 years or less, then you could be exempt from doing that, as well as other things. But the next slide kind of goes into specifically one type of temporary difference, and that is called the recurring item exception. And this allows a taxpayer to deduct certain expenses that are incurred through the filing of the return. So that's going to be, even if the return has been extended and you file on 9/15, like you wait the longest amount of time before filing, there's certain expenses that, as you pay them in that subsequent year, you can deduct them on the current tax return that we're preparing. So in general, a tax basis, or a accrual basis taxpayer is allowed a deduction for an otherwise deductible expense in the period in which the all events test is met. And my understanding of the all events test is that there has to be some kind of a liability. So as an example, insurance contracts, there's usually, you enter, like for general business insurance or other things, you have an annual contract that you renew. And so there is a liability. So there's a signed contract. The liability has a reasonable, the amount on the liability is reasonably determined so that you have amount per that contract, and that economic performance has occurred. And in general, economic performance is occurring as the services or property are provided or consumed. So what the recurring item exception is allowing is for the deduction in the tax year before that economic performance occurs. And again, this is made so the all events test is then deemed to have been met if for all the expenses for those certain types of contracts, if they're paid within 8.5 months after year end, or the maximum amount of time before you have to file that return. And so on the next slide, so this is it's a temporary difference that will kind of reoccur each year. It's not available for cash basis taxpayers. So the recurring item exception can be adopted. So it is an election that you have to make, and it can happen at the initial year of the company. Otherwise, you'd have to file a Form 3115, which is a change in accounting method, at any subsequent year if you choose to do so. And in general, the recurring of the recurring item exception generally means that those expenses are incurred from one year to the next. I mean, they're kind of normal expenses like that. So, but specifically, there's only certain kind of types of expenses that qualify. The most common, I think, are insurance and warranty type expenses. So the last few slides were on temporary book tax differences, but these are listing more permanent differences. So these are items that are not going to reverse. Most of them relate to non-deductible expenses that you list as a deduction on the book, the financial statements, but then have to add it back to taxable income because they're non-deductible expenses. So in general, meals are 50% non-deductible, but I did learn something in the tax updates. I think they said for 21 and 22, if the business meals are held at a restaurant, then they would be 100% deductible. So that's important to note.
I think they have to come from a restaurant. I don't think you have to consume it at the restaurant.
Is that what they meant? Okay, I missed that
that's
nuance. Yeah. Okay. So okay, so you're saying that could be catered from a restaurant.
Yeah. Mm-hmm.
Okay.
Mm-hmm.
But I mean, still, I mean that's it's an important distinction from previous tax years because it used to be only 50% was deductible. And then on the entertainment side, 100% is non-deductible. On the non-deductible contributions, I think they follow the same rules as individuals in general. So examples include political contributions and the portion of a contribution that includes fair market value of goods or services. That portion would not be deductible.
And contributions to, political organizations.
Yeah.
Sometimes the whatever industry that the company is in, whatever that supporting organization is, a lot of times they'll make contributions political in nature, and those are not deductible. So you need to look at some of those too, because it'll say, 2% of the contributions that you gave us went towards political or non-deductible. So a lot of times we need to look at that. And as auditors, sometimes we do. Depends on materiality and how much the client does to come through. So.
Let's see, parking costs. So the Tax Cuts and Jobs Act had put in place that certain qualified employee parking costs were considered fringe benefits and were non-deductible, I think, unless you added them to the employee's taxable income. Penalties and fines have always been non-deductible. The dividends received deduction is not necessarily a non-deductible expense, but a reduction in income. So this is for C corps only. So this deduction allows a C corp to exclude a portion of from taxable income amounts received as dividends from other C corps that they own stock in. And I think I said this before, but with permanent differences, they will not reverse like temporary differences. So a couple important things to note is that temporary differences, again, they will reverse from the prior year unless. So it's important to understand what you did last year and know what needs to be reversed or dealt with in this year. And so what's helpful in doing that is having a book tax work paper reconciliation, whatever you want to call it. And we do have a example of one that we can share, kind of go through really quick. And we did not have a chance to put this up on the conference website, but if anyone wants a copy of this, reach out to Kim Martin or pretty much anyone at Hanson Weeble, and we can provide this to you. But in general, you basically have a column that is reconciling book income, and it kind of goes through and identifies a lot of book tax differences, and then you get to your taxable income at the bottom, and you'd have a column for each year. So you're just adding a new column each year, so you can see start with book income, and then have a number of permanent differences that just are added back to book income because they're non-deductible expenses, and so it needs to increase to get to taxable income. And then depreciation, we have the book depreciation and the tax depreciation, basically to get the difference. And in both those years, the tax depreciation was higher than book depreciation, most likely because there was a good amount of bonus depreciation that was taken during those years. And then down further, so kind of illustrates So looking at the allowance for bad debts, I said that the allowance a method for book is not acceptable for tax. So that initial year in the 2020 column, we're adding back $420,000 to taxable, or excuse me, to book income to get to taxable income, because that was the balance of the allowance for doubtful accounts on the balance sheet. And then in the next year, we're reversing that 420, but then we're adding back what the 2021 balance of that allowance for doubtful accounts. So in the current year, the change is just $5,000. And so next year you'll kind of just follow that. And so yeah, those last four items are just examples of ones that will reverse in the following year. And then it comes down to then taxable income. And typically with this kind of work paper, I would try to make sure that, of course, the book income reconciles or agrees to what the audit says, and then the taxable income reconciles to the taxable income on the tax return, just to as a double check.
Yeah, and I think this M1 schedule is probably required for every business return we do coming through, and you should have checks and balances. If you're doing it in engagement, if you have your book income, you should tie your tax trial balance and your book trial balance together, and then tie it back to these schedules. And typically, just a helpful hint, and Monty, I don't know what you do, but typically I'll have something in here where it says, page 1 of the 1120, right?
Yep.
And then if there's differences, then I'm identifying them. And a lot of times when you're putting stuff into the tax return, this is probably the best way you can find to reconcile everything, because some returns have a lot of numbers in there. And you really want to zero in, where is my error? And I would say 75% of the time it's because you probably put, or I put one of these in backwards in the tax return, or something changed along those lines. So it's really important to reconcile those, just to really hammer home what Monty was saying, to make sure you do that. It'll save you some time in the long run as well.
Yeah.
So, and this is something else that, I think C Corps are gradually being phased out a little bit, but I know we still do. We have more than a couple audits that we do for that, as well as we do the tax return. But don't forget the deferred tax for C Corps. And a lot of times, we're doing the M1 schedule as the auditors, and either we're doing it in conjunction with the tax department, or we are actually doing the return. But the deferred tax calculation you got to do, it's really stemming from a lot of these temporary differences. The permanent differences that you do will not affect that deferred tax. And I'm not going to spend a lot of time on this, but I did want to spend just a second or two on it coming through, because if we look at some of the items that change, obviously we have depreciation differences, book and tax. If you have net operating losses, obviously those NOLs are going to reduce your taxable income in a future year, which makes it a tax benefit, right? So that would be a deferred tax asset. So it's a good way to keep track of the NOLs. And also, since 2018, prior to 2018, you could deduct 100% of your income with NOLs, but income or losses generated from 18 going forward, you were subject to an 80% limitation. So this is a good way to keep track of that, and it helps you reconcile on the tax return as well. This particular one, we're talking about 163J, the disallowed interest. That's interest you're not allowed to deduct in the current year return. Well, you can deduct in a future year return. So that would be a deferred tax asset as well. And you come up with your rate. In this particular one, we're using a blended rate between federal and Virginia. It's not exact, but for audit purposes, it's pretty good. And you multiply it out to figure out, well, what is my deferred tax asset and liability to come through, that's a disclosure that you're needed in the notes. But while you're doing that M1 schedule, the book tax that Monty's saying, it's easy enough to just go on and try to do the deferred tax calc if you have that in your audit.
All right, so yeah, so we kind of covered the book tax differences there, and so I touched on it briefly, but definitely wanted to throw in some information about Form 3115, which is the change in accounting method, because there can be times when we come across changes for book financial reporting that are allowable for tax, or they might not be allowable for tax. So as part of the audit, I think it's important that we be mindful of what kind of changes are happening on the financial reporting side. And some of this could be prescribed accounting standards updates from FASB for GAAP financial statements, or maybe it could be the client changed the way that they're doing inventory costing, or maybe an overhead allocation or something. So any types of those changes, I think bottom line, I don't think we should assume that what we're doing for book is going to be what we need to do for tax. And so anytime there's changes in that financial reporting, we need to understand if we need to file a 4115 change in accounting method. And so I have in here that there are final regulations for Section 451. Now I'm not gonna be reading any IRS code in this session, but in general, at 451, I believe it was kind of in a response to the Rev Rec, the 606 changes for GAAP. But in general, it deals with the timing of revenue recognition for accrual taxpayers. And one of the things in there is that it's required that to recognize revenue no later than when recognized on a set of applicable financial statements, which include a GAAP audit. But I guess the bottom line is that when we have a change in reporting, financial reporting, is that it may be acceptable for tax, but we might need to file a 3115, or it might be unacceptable for tax, and then we'd be dealing with a temp or a perm book tax difference. And so the earlier we can identify those items that do need a 3115 are going to be better. If we can do that in the planning stages of doing the tax return, or maybe during the audit, versus when we're doing a tech review on the tax return and we're pushing up against the deadline, it's going to be a better process for everyone if we can get that done earlier.
Yeah, and as a practical matter, I mean, as you guys are doing your control walkthroughs, how do you formulate these estimates? How are you coming through? How are you capitalizing items for inventory? Just keep your radar up for something saying, well, we tweaked it a little bit, or we changed it a little bit, because those things could matter. And just jot it down in your notes, and then go talk to your in charge or the partner in charge and say, hey, do we have an issue with this? Additionally, when you're in the actual audit or review stages, and you're going through and you're looking at these things, and you're like, well, analytically, I'm testing this, or I'm testing how they calculate it. It's a little bit different. They're including different things in here. I mean, those are the times that you're going to need to identify those and bring them up. And like Monty was saying, the worst time to bring it up is if the tax return is due March 15th and you figure it out on March 13th. And you're like, okay. And filing 3115, there's a lot of automatic elections in there. But it's not always as simple as just checking the box. Sometimes you got to calculate, well, what was the difference here? Is it a net taxable income? Is it going to cause tax? And you have other elections in there. So trust me, it's not something you necessarily want to deal with on the last day or two of a filing deadline. Anyway, so.
Yeah, so that brings us to the first code word, which is GAAP with 2 A's.
All right, so the next item we're going to go through is issues related to S corps, and really we're going to focus on with the S corp. Has it always been an S corp, or was it converted to an S corp? I want to say probably, and Rich, you might have to correct me on this because it seems like 1986 was a date. Is that when S corps were coming in? It was before my time coming in, but I know a lot of people. What's that?
No, I was going to say that the S corps existed prior to '86, but the whole rules changed drastically. So a lot of C corporations elected to be an S corp effective 1/1/87. But it was a completely different regime. So still a flow through, but it was different.
And I think things have kind of changed since I've been doing this, in that I think LLCs have become more in vogue, and LLCs can be pretty much taxed as a sole proprietor, a C corp, S corp, or partnership coming through. So it's not necessarily it was formed as an S corp. They could have been a LLC that was wanted to be taxed as a C corp, and now we want to be taxed as an S corp. So, going through. Was it an S corp virgin, initially an S corp, and why does it matter? And I think the main thing going through why it matters is C corps are subject to double taxation, right? So the C corp is its own entity and it's taxed at now it's taxed at 21%. And then as the owners get money out of it, it comes out as dividends. So if you're initially a C corp, the IRS wants to maintain that relationship in there. So when you switch over, all of the gain that you had as a C corp needs to be taxed as a C corp, and it's not necessarily recognized gain, it's realized gain, right? So you could have a lot of stuff on your balance sheet that you haven't sold off or gotten rid of yet, but it has an inherent value at the date that you transfer. So one of the easiest ways to look is to look on page 1 of the 1120S, and you can see when was the S election effective date, and then when was the date incorporated. So you can see obviously this one was 20 years later, so there's probably going to be some earnings and profits in there. The next place that I typically look to, and we're going to get into more detail a little bit about this, is how much E&P do they have, earnings and profits. And this is another place to look. And I think this form, the M2, is within the last couple of years that it's come out. It used to just be a question on one of in the tax return. But if you look, the retained earnings here, beginning of the year was $2.4 million, and their beginning of the year here is $1.3 million. So you have about $1.1 million thereabouts that is potentially earnings and profits that when it comes out, it needs to be taxed or come out as a dividend. Now, there is a column for accumulated earnings and profits that, could be populated. In this particular example, it's not. So, we were talking about before, I was saying when you convert from a C corp to an S corp, you have a realized value, but you haven't recognized it yet, right? So when you switch over, you need to have there needs to be some type of appraisal or valuation done to figure out what is the value of the assets. And it's not just, you go through, it's not property and buildings and fixed assets, but it's, what's the value of the inventory? What's the value of my AR depending on what method you're on, if you're on accrual or cash method. What's the value of goodwill? What's the value? Everything just going down the balance sheet, you could have a built-in gain or you could have a built-in loss theoretically coming through. And for a period of about 5 years, it used to be 10, I believe, you have to recognize as you get rid of those assets, you need to recognize those at the double taxation, at that the S corp will get taxed at the 21% C corp level, so that the government gets its money. Now, the recognition period begins on the first day the X election is made, and then if you dispose of any of those assets for the next 5 years, you need to recognize, a built-in gain or built-in loss for that. And so in a sense, and I've done this for a client or two, someone, you'll have a valuator go through, and let's say you have a fixed asset schedule, and they will determine what the fair market value of those assets are as of the day that it transferred over. And let's say someone had a vehicle of some sort, and they said, okay, we're going to dispose of the vehicle. We sell the vehicle, and it's in year 3 of this. Well, you need to determine what was the actual gain or loss on the sale of that vehicle from using all the depreciation that you did, tax depreciation, and what did they sell it for? And you have a gain or loss there. And then you go back, well, what was the gain or loss when they converted to a C Corp, right? And you take, if it's a gain, you take the lesser of that gain, and that's what would be taxable under the big built-in gains tax. So we talked a little bit about earnings and profits. And where that matters is when you're an S Corp, if you think about it, you come through and an S Corp receives income, and essentially whatever cash that they put in to the S Corp, will add to the retained earnings. Whatever income they have will increase that. And then when you take a distribution out, you can get that distribution tax-free up to the amount that you have AAA, right? So AAA, it's a little bit more complicated when you convert from a C Corp to an S Corp, but the ordering rules are just like I said. If you were never a C Corp, if you were always an S Corp, you wouldn't have to worry about this at all. Any distributions you get out pretty much are, up to the amount that your basis is going to come out tax-free. But when you convert from a C Corp to an S Corp, those earnings and profits, you'll have that's going to stay as a layer in your retained earnings, more or less, right? So whatever income you had beforehand, right, all of that's going to add up to your AAA, right? And AAA is essentially increases to income other than tax-exempt income. That'll go to OAA. And then you decrease it for non-deductible expenses. We were talking about the entertainment, meals, and penalties. You'll also decrease it for deductible expenses, but you don't include the expenses that related to tax-exempt income. I think some good examples of some of that could be PPP loans, right? So you get a PPP loan that was forgiven by the government. That doesn't increase your AAA, but it increases your basis, okay? And theoretically, and have to talk with some of the people in the tax department, whatever expenses you used, the treatment of, that the PPP loan, those expenses, how you treat those, I think that's another discussion, and that's more than I want to get into right now. But as you get distributions out, you can take tax-free distributions up to that AAA amount. And then once you get past that AAA, any distributions you get out after that, it's going to come out as a dividend. So you're going to have to the company's going to have to issue a 1099 div to whoever it comes out at, right? Then after you exhaust all your earnings and profits, then you start getting into, does the shareholder still have basis? If they still have basis, it's a tax-free distribution. If they don't have basis, then it's a capital gain on the money that comes out.
Hey, Matt.
Yeah.
I'll throw this out here because we might not get to it for time, but there is a federal election that you can take, that S Corps can take to bypass distributing out of the AAA. And so there could be scenarios where it might be worth taking a taxable dividend for shareholders if there's other losses that can be applied against it so it's a planning opportunity, but I just want to put that out there.
Yeah, no, I think that's good. There's also an election you can make, and just keep this in the back of your mind. When you're going through the distributions, the order of it, it's not necessarily bypassing AAA, but some of those deductions, non-deductible expenses versus deductible expenses, you can flip the ordering of those and be able to take distributions, and then your non-deductible expenses, doesn't reduce the amount you can take as a distribution, right? The only problem is those carry over for a long time, but that's another planning opportunity if you notice someone wants to get money out, but they don't have enough basis in it. So I guess we got 10 minutes left, right? So yeah. I'm going to try to go a little bit faster. We were talking about earnings and profits coming through. Let's see here, coming through. One of the things, it can affect the character of the S Corp distributions, which we talked about. Is it a dividend? Is it a tax-free distribution? Is it a capital gain? If you have excess net passive income, there's something known as the sting tax, which if you were a C Corp prior to this, it kind of follows the rules of a personal holding company for a C Corp. And just real quick, a personal holding company for a C Corp is if you have, I think it's 5 or less owners and 60% of the income is coming from passive sources. Well, a lot of taxpayers will use that as a way to never have to pay tax or double tax on that passive income. So they would hold on to it. And the government said, time out. No. We're going to add additional tax to it. S Corp's the same way. So you can blow your S election on that if you have too much passive income and you were a C Corp prior and you have earnings and profits in there. So we talked a little bit about the distributions coming from an S Corp, just what we were saying before, non-taxable distribution to the extent you have AAA. Another thing is the AAA and earnings and profits. I mean, this is a corporate level concept. So the company is going to be keeping track of its AAA, the retained accounts, but the shareholders basis, that's outside. It's the shareholders' responsibility to keep track of what they paid for it and what their basis is. So they need to be keeping track of that coming through, which in some ways blows my mind a little bit, partially because the one entity that probably knows best how to keep track of that is the organization rather than the shareholder. But it is their responsibility. So we talked a little bit about the sting tax coming through. Yeah, we talked about that. Okay, so how is owner's basis calculated? And I'm going to go really fast in the purpose of time here. We'll go through. Let's see if there's anything in here. Yeah, I mean, I think the main takeaway from this for you guys as we're coming through, it's really important. We need to track the basis because it does affect the character of how the income is flowing out through to the owners if it's a partnership, and when they're taking distributions. And I think the main difference between one of the main differences between a partnership and an S Corp is the treatment of how loans and shareholder loans and liabilities are treated. So if you have a partnership that has a lot of losses generated, the owner can get bonus, or not bonus, but can get basis from those losses as long as they have debt that they are personally at risk for, right? And it matters if it's recourse or non-recourse. So if you're auditing a partnership or doing a tax return for a partnership and you see that they have liabilities, you're going to want to know who is responsible for those liabilities coming through. Conversely, with an S Corp, the only way an S Corp can get additional basis from that is if they do a shareholder loan to the S Corp, right? So if the S Corp is throwing out a bunch of losses and they've exceeded their basis, if the shareholder has given a loan, they can take those losses and they don't get suspended up to the amount that they have loaned with the S Corp. Now, something you need to look out for is if there's multiple owners, They all have shareholder notes with it. They're not proportional. And when you pay those notes off, if the owner was using that as basis so they could have losses, it's essentially treated like a cash distribution for them. So it's one of those things at the year end, they go on and pay off a lot of these notes and throw distributions out to the S Corp holders. And all of a sudden, before they know it, they have a taxable distribution to them. It's taxed at capital gains, which throws everyone off because they weren't expecting it. So you just need to keep track of if an S Corp has loans or a partnership has loans, what happened to those, what were the distributions, and what was the basis. We got about 4 minutes left, so let me see, going through.
Could feel everyone's anxiety because they've only gotten one code word so far. So,
Yeah.
The next code word is before, BEFORE.
Yeah, there we go.
Yeah.
Before. So self-charge interest, I'll go real quick on this. I mean, the whole premise behind it is when a partnership, let's say it's a passive partnership, throws off interest to the shareholder, they're going to include that interest as portfolio income. However, they have the interest expense that the partnership threw out. It was an ordinary expense. So it's taken as ordinary, so it flows through to the individual as passive. And you can there's an election in the tax return where the individual can elect to have that portfolio interest treated as passive, so you can use those passive loss that came from the partnership. Otherwise, those losses have the potential of being suspended for a really long time. But you do have to be careful with NII. If it's self-charge rent, NII, you don't have to include it as long as you're active, right? So, but as soon as you make that as passive, there's a potential for it to be subject to NII. Self-charged rent is the next item. What you just got to keep in mind when you have a client that has an operating company and a rental company renting the property back to them, there are rules on how that income from the rental company has to be classified. And essentially, they're trying to get away from you moving income out of the operating company that generates self-employment tax and putting it to a passive activity that doesn't generate self-employment tax. So essentially, if you have the rent, it's really an IRS pro rule in that if you have non-passive losses, if you have income that's non-passive, it goes as active and you can't use it to offset passive losses. But if you have a loss, it remains as passive. So just keep that in mind as you're coming through those companies. We have a lot of those.
Matt, two things.
Yeah.
We got our first technical review comment.
Did we?
From Rich, says actually the self-charge rules are not elected, they're mandatory.
But the organization, well, never mind. Okay. Yeah, we'll go through. It works. Common elections.
Yeah, common elections. I say we kind of forego going through these. Basically, it was just so elections are a way of entity telling the IRS what they're going to do, and sometimes you're opting out of things, sometimes you're opting into things. But there's a list of common elections that you might see. I thought we should go to to the last slide because that was a new kind of overall topic that was yeah.
Here we go. So, as you're going through, try to find a way to incorporate the tax department into your planning meeting. You don't necessarily have to pull them into the entire planning meeting, but they need to be involved in decisions. I mean, is there any serious going on with the company? Have they gone to different states? Do they have employees working out of state? Did they get a PPP loan? Did they get the employee retention credit? I mean, all those things can affect the return, and it's best to deal with those ahead of time, especially if there's planning opportunities for it. So,
Yeah. So, yeah, so looks like we're at time. The last code word is tax. TAX. And so obviously there's a lot of information that we did not be able to get to, but there's a lot of information in those slides that could be helpful, at least to reference or something to jog your memory as you start your year-end audits. So are there any other questions? If not, we appreciate your time.